and welcome to the Money Show. I'm Kavita Thaplayal, and this is the place where money stops being confusing and starts working for you. Because let's face it, every decision we make, from the coffee we buy in the morning to the home we dream of owning, from planning your next holiday to securing your child's future, has one thing in common: money. Yet despite the role it plays in every chapter of our lives, very few of us were ever taught how to manage it, grow it, and make smarter financial decisions. That's where we come in. Whether you're just starting your financial journey, building wealth, investing for the future, planning your retirement, or simply trying to make your salary stretch a little further, this is your show. Every day, we'll cut through the jargon and the noise to bring you practical advice, expert insights, smart investment ideas, tax saving strategies, market trends, and actually matter to you. Honest conversation about decisions that can help you build a stronger financial future, because personal finance isn't just about numbers, it's about freedom. This is a show where you can ask your questions. We'll flash the WhatsApp number, note it down, send your portfolio details, and we will help you navigate through all of your investment strategies to achieve all of your financial goals. 865-797-4571. The email ID is themoneyshow@etnow.tv. So a very important and interesting discussion today. If you are an NRI or have family earning overseas, your money has a golden window in India right now. Thanks to the recent Reserve Bank of India interventions, Indian banks are offering unprecedented interest rates, some touching over 7% on foreign currency deposits. Now, it's like taking a gamble on currency rates. You need to know about the FCNR account, or foreign currency non-resident deposit. Now, think of it as a supercharged fixed deposit, but with a massive twist: zero exchange rate risk. Normally, when you send money to India, it converts into rupees. Now, if the rupee falls, your investment value shrinks. But with an FCNR account, your money stays exactly as you sent it, whether that is US dollars, British pounds, or euros. But there is a ticking clock. This special window shuts entirely on September 30th, 2026. The only catch under this special promo, your fund faces a strict 1-year mandatory lock-in period. So today, we break down the mechanics, compare the top banks, and expose the hidden traps you can make an immediate profitable decision. We'll help you with that. And for that, we are joined by Sanjeev Singhal. He is the co-founder and chief growth officer of Scriptbox. Sanjeev, hi, good evening, and welcome to the Money Show. Something very exciting.
Hi, Kavita.
Thank you. Let's discuss the yield dilemma, okay, the currency depreciation. Historically, the Indian rupee depreciates against the US dollar by about 3 to 4% annually. Now, if an investor locks into an NRI account at 6.5% in rupees versus an FCNR account at 6% in dollars, isn't the FCNR account a mathematically superior choice for preserving true purchasing power, if we have to analyze and look at it that way?
Absolutely. So I think a normal deposit will ultimately perform as good as or slightly worse than deposit in your own currency. So if you're living in the UK or US and you were to place a deposit in a local bank, your net yield would end up being about the same. But in an FCNR, especially now, you've got a significant advantage. But as you said earlier, it's a short-term window.
Exactly, the short-term window, that is the window where you have to understand all the catches for your investment. But also, if I want to focus on the global tax friction. Now, Sanjeev, while the Reserve Bank of India guarantees that FCNR interest income is 100% tax-free in India, how does this hold up for NRIs residing in high tax jurisdictions, like US or the UK? Won't the IRS or HMRC tax, this global interest income anyway, effectively wiping out the premium yield advantage? Can we say that can happen?
Yes, it does happen. So I think, for example, NRIs in, say, UAE or Singapore, there is no tax. So the entire 6% or 7% yield comes directly to your pocket. But if you are in the US or UK or some of the other geographies, you will end up paying tax on this amount. But what you must remember is that you have to compare it not as an independent investment option, but with, say, a deposit in your own geography. So if you're earning 4% sitting in UK and you're able to get 7% in an FCNRB, The 3%, even if it gets taxed, is still giving you a slightly better yield than what you would have been able to get in your home market.
Got it. Sanjeev, let's just focus on the Fed versus the RBI interest rate arbitrage. Slightly technical. Now, with central banks globally adjusted to a higher for longer rate environment, US Treasuries and domestic dollar CDs are offering stronger yields. Why should a risk-averse NRI move capital to an Indian FCNR deposit for a 6% yield when they can get close to 4.55% at home without cross-border regulatory risk?
So I think it's a question of, so there is that risk that you have to assess.
Right.
So 4% is typically what US Treasuries are giving. And if you're able to get 6%, that's actually a 50% higher risk, higher yield, right? And is that risk worth taking? So especially if you're an Indian and you believe in, you have a belief in the Indian economy, people do tend to place these deposits, right? So it's a question of you can move some of your other FCNR deposits, or you can move some of your resident money into that, or take a call between assessing what you're able to get in your home market versus what you're able to get in India. Yes, but there is no risk really, right? So there's no additional risk that you are taking because you're not taking a sovereign risk. You're taking a risk on a bank, right? And the bank risk between a bank in the US and a bank in India would probably be about the same, specifically the larger banks that you've listed on your screen.
All right. Let's talk about the promotional trap, okay? The special RBI framework is active until September 30th. This forces banks to implement a strict 1-year mandatory lock-in with zero premature exit. In a volatile global economy, is locking up a hard foreign currency for 12 months with zero emergency liquidity a smart risk management strategy for an average household? How can you explain and how should one look at it?
So I think the key word there is an average household. So I
Okay.
think some of these elements of liquidity, I think a lot of us don't give liquidity due importance. So when you make an investment, you're not just looking at risk and return, you're looking at liquidity and taxation. You already mentioned taxation earlier. So liquidity is another one. So if you can't afford to lock money in for a year, you shouldn't be getting into this. It's not worth it for the slightly extra return.
Now, since you ended with that word extra return, for an NRI, looking at a 3 to 5 year horizon, locking capital into a fixed income FCNR asset yields around 6% compounded. Why shouldn't that investor look at the Indian equity market instead, where even conservative index funds or large cap mutual funds have historically outperformed fixed deposits? Is that a better choice?
Yes, I think we should not confabulate or mix up two different asset classes. I think ultimately you have to start with asset allocation. So your equity money goes into equity and your fixed income money goes into fixed income. If you're moving money from fixed income to equity for simply getting extra return, that doesn't work. So we are essentially, when we are talking about investment here, you're talking about your fixed income allocation and not your equity allocation, for example.
Right. So this can be like a debt part of your portfolio.
Yeah, debt part of your portfolio, which is
Absolutely.
long term,
Which is
you
long term.
can, yeah.
Yeah. So one case now, Sanjeev, many NRIs open 5-year FCNR accounts with a plan to permanently relocate back to India midway. Now, once they return, their status changes to RNOR, resident but not ordinary resident. Exactly how long does their FCNR interest remain tax-free here after they land in India? And at what point does the Indian tax department start taxing the foreign income then?
So this is slightly complicated. I mean, this resident and
Right.
not ordinary resident piece
Yeah.
is a slightly complicated one.
Yeah.
So I think I would advise that they consult with a tax consultant for this, right? It's not simply an investment decision. And if you're looking at moving halfway through your tenure, that itself introduces another element of consideration in the liquidity window itself, right? So then you're not looking at a 5-year duration. You're then looking at a 2 or a 3 or a 1-year duration for your investment, and that's something that you must factor in before you make this investment decision.
One tax-related question I have, I'm not sure if that's the right question to ask you. If a viewer opens a joint FCNR account with a resident Indian relative, like a parent maybe, to help them manage funds, you think there'll be any tax implications involved?
So as far as my understanding, I don't think you can do a joint account with the
Okay.
resident, FCNR account with the resident.
Okay, okay, okay. All right. In the end, before I let you go, how, according to you, viewers should make the best use of this window? This is the golden period till 30th September. According to you, what should be the list of do's and don'ts?
So simple. I think start with your asset allocation.
Okay.
This has to be your long-term fixed income money. If you have money available for you to invest for 3 to 4 years, that's what you should invest in this. Yeah, that's as simple as that.
Sanjeev, I think that will be all. Thank you so much for taking your time out and helping our viewers with this today. Thank you.
Thank you, Kavita, for having me. Bye.
All right, it's time for a short break on The Money Show, but post that we'll be answering your portfolio queries. We'll be joined by Uday Thoot, our financial planner today. But I'll also flash the WhatsApp number on the screen so that you can note it down and ask all your investment-related queries. The Money Show at ednow.tv, the email ID 865797457. Welcome back. You're watching The Money Show and it's time to answer your portfolio queries. Uday Thoot, our guest on the show today, has joined us. Uday, hi, good evening and welcome to the show. Uday, we are also joined by our first viewer. His name is Aditya Sharma. Aditya, hi, good evening. How are you?
Yeah, good evening, madam. I'm good. How are you?
I'm doing good. Thank you so much for sending
Thank
us
you.
your question. Uday can hear you. You can ask away your query.
Sure. So basically, I'm looking to invest around 50 lakhs
Okay.
from windfall capital gains after selling my property.
Okay.
And I have a list of mutual funds which I've selected,
Sure.
which are Parag Parikh Flexi Cap, HDFC Flexi Cap, Motilal Large and Mid Cap, Invesco Large and Mid Cap, and HDFC BSE Sensex Index Fund.
Okay. Got it.
So my query is like, if this selection is good to go for long term, if I'm looking for more than 7 years, I don't have any specific aim to build up right now. I'm just looking for a good investment which will generate a good return.
Right, right.
So
Since how many
and,
years you've invested in these funds? I mean, what's the timeline? You're already like 1
I-
year up?
I have just started.
Just started. Okay.
Yeah.
What's the amount?
So total amount is 50 lakh lump sum I'm having, but I'm planning to invest it in a staggered way. So,
Right, yeah, makes sense.
one is like if this fund selection is good and whether how much time I should stagger my investments considering the uncertain market.
Yeah.
And since till then, like if say I'm investing in 6 months. So for 6 months, I have some list of funds like overnight and debt funds. So whether those are good. So those names also I have it. If I can tell, then I can bring it forward.
Yeah, we have you've given us Kotak Arbitrage, SBI
Right.
Arbitrage, SBI Ultra
Right.
Short, SBI ICICI Pru Saving, and SBI Overnight. Okay, let's just see what Uday has to say. Uday, I think Aditya has a lot of clarity on what he wants. What should be the strategy then? The timeline is very crucial, 7 to 10 years.
Yeah, Aditya, thanks so much for your query. I see that you have some clarity in terms of what you really want. As you mentioned, this came from a sale of property and you want to essentially put pretty much all of it in equity. I'm assuming that sort of suits your overall sort of asset allocation and requirement per se. I'm going by that assumption. In terms of allocation, you've kept some of these flexi cap funds, which are good and which have done well. Just that over a period of time, these flexi cap funds have become pretty large. So maybe for some of these flexi cap fund, you possibly can choose an option of maybe putting in some money in, say, a Helios flexi cap fund. That could be an option to mix and match with the flexi cap funds that you have selected. That is one option. And you could possibly also look at some of these newer small cap funds along with the small cap funds that you looked at. So maybe you can look at Abundant small cap fund and Abacus small cap fund. You have not kept any debt. So what I felt that maybe you would want to do something like an hybrid, like a balance advantage fund and ICICI balance advantage funds. Around 10-15% of your allocation can go there. The rest of the things sort of look well. We have sort of put together all of this. In terms of your questions, you had two other questions. One was, where should I park this money in the interim? So what I would suggest is that see whichever is the target equity fund that you are selecting. So let's just say you are selecting HDFC Flexi Cap Fund or a Bandhan Small Cap Fund or an Invesco Large and Mid Cap Fund. You can either choose the arbitrage fund there or the overnight fund there, and then just do an STP from there. So that way, what will happen is that you don't have to again and again worry about the money coming to your account. So let's just say you are deciding that I'll put 5 lakh rupees in Invesco Large and Mid Cap Fund. So either in the overnight fund there or the arbitrage fund there, you can put in that 5 lakh rupees and do like a systematic transfer from there, from the arbitrage fund or the overnight fund to the equity fund. So that way you would do not have to continuously worry about money coming into the bank account. So I would say maybe choose a period of 9 to 12 months to sort of stagger your entry into the market. And yeah, if there are any further queries, let us know, please.
Sure. All right. I think the strategy has been laid down, and Aditya, all the best. 9 to 12 months, a time frame where you can stagger the money. Let's move on. Avinash Singhal, let's take his question. And he's investing almost 1 lakh per month across 5 funds. You have the names. He has flexi cap, small cap, and mid cap, multi asset also. He wants you to review and also is seeking advice on rebalancing. So he's got Parag Parikh flexi cap, Axis small cap, Kotak mid cap, White Oak multi asset, ICICI gold ETF. Okay. All right. I think Avinash is there on the phone line also. Avinash, hi. Good evening.
Yeah, hi, good evening, ma'am. Thanks
Hi.
for allowing me to be on your show.
Sure. You're calling from where?
I'm calling from Delhi.
From Delhi. All right. So you've given us the portfolio. Thanks for that. This SIP is going on since how long, Avinash? If you could just give us a time frame.
Ma'am, actually, I started off in 2022 beginning with
Okay.
30,000 of SIP in 3 funds,
Sure.
Parag Parikh and Axis and Kotak. And probably in the past 2 years, I added this White Oak multi-asset. I think they started off an NFO. That is when I joined this fund.
Okay. Okay.
So the amounts I have basically increased now. I had put this query about 1 month back, but got a call now. So I have increased the the allocation, and I have also pulled out from ICICI gold ETF. So right now,
Okay. Okay.
yeah, I mean, till last month I was putting in money in ICICI gold ETF. Now I'm not putting it anymore.
So the money is still lying there, right? You haven't redeemed anything.
No, I haven't redeemed it, but I have moved the 15,000 every month, which I was putting into gold ETF. I have moved it to multi-asset.
Multi-asset. Okay. So you are looking for what's the time frame of this investment now going ahead? 10 years, 15 years?
Yeah, ma'am, max 10 years. That is when my daughter probably she's going to be ready for her college.
Got it.
And the amount that I am going to increase now, I am currently doing 55,000 in Parag Parikh, 35,000 in Axis, in Kotak, and 35,000 in this one, White Oak.
Got it. Okay. Uday, few changes, but how is the portfolio mix? And also, Avinash, any corpus that you want to accumulate after 10 years?
Yeah, ma'am, right now I'm at a 47 lakh corpus from this. And I mean, I don't have any specific target. I just want the drawdown to be minimum in my portfolio. That's why I've kept a lot of my money in Parag Parikh.
Got it. All right. Uday, your take.
Okay, thanks so much, Avinash, for your query. First thing that I would like to say, if this is something that you're saving for your daughter's education, then also do match it up with appropriate amount of term insurance. You are definitely saving on a regular basis and consistently, but it's good to also have that protection so that that goal is met irrespective of what happens. That would be my first recommendation to you. Onto these schemes, see, these are, from what I see, it's almost like 100% equity portfolio with some multi-assets, so maybe around 15% gold and debt is coming through the multi-asset fund that you have selected. So during market downturns, do expect that will happen in the portfolio. Drawdowns will happen, even it's almost like an 85-90% kind of an equity portfolio. So you should expect drawdowns. This is just to comment on what you said, that I don't want too many drawdowns. Having said that, you have a fair amount of long-term horizon. So I'm assuming this is for your daughter's education, so you can definitely stick around for a longer period of time. Now, coming specifically on the fund selection, what I would say is that, hey, I know you have a fairly decent amount on Parag Parikh Flexi Cap Fund. then there is Axis Small Cap, Kotak Mid, and you sort of switched off from the ICICI Gold and moved that money to the White Oak Fund. I think overall the fund selection as such seems fine. On the Parag Parikh, I would say that hey, maybe given that you have only one flexi cap fund there, maybe add one more flexi cap fund as such there is what I would recommend you to do. You're almost like a 25-30% of your corpus currently is going into that one scheme. And I'm assuming you have already a decent amount of corpus in that scheme. So maybe a little bit of reduction there might be beneficial. If all the money that you had in ICICI Gold is now being moved to the multi-asset fund, maybe you would want to add one more multi-asset fund instead of doing all of that in one single place. That's all that I would recommend. Apart from that, Axis Kotak you can continue. For the flexi cap, maybe you can look at Helios flexi cap fund is an option. In the multi-asset, both ICICI multi-asset and DSP multi-asset are options that you can kind of look at.
All right, I think that's a strategy, Avinash, that's been recommended. I don't have you on the phone line, but I hope you've got this recommendation. And if not, then you can just watch the show again on the YouTube and note down the changes recommended. But with that, we are time for the show. Thank you so much, Uday, for being there for our viewers today and helping them with their portfolio queries. And for our viewers, whether it's investment, insurance, tax, or any aspect of your financial planning, we are there here to help you. Just send across your questions on the WhatsApp number or the email ID that you're watching. Any investment aligned with any goal that you need help with, our experts are there to give you a financial plan for that. Thank you so much. Goodbye.